Are you curious? Is it a buyer's or seller's market on the horizon? Let's dive into the data and explore the real estate forecast for the next 5 years, focusing on home prices, mortgage rates, and home sales. Plus, we'll address the pressing question, is a housing market crash imminent? Now, whether you're planning to buy your dream home or strategically sell an existing property, this video equips you with the insights needed to navigate the housing market confidently. Hi, it's Christopher Brixmar with MMG Real Estate Advisor, your local Orange County realtors with a 5-year forecast and some key insights. Now, let's dive into it. The housing market of recent years, driven by ultra-low mortgage rates and intense buyer competition, has many wondering, what's next for home prices? Data from the National Association of Realtors as of April 2024 shows the median existing U.S. home sale prices are near record highs at $419,300, a 5.8% increase from May of 2023. The California Association of Realtors reported April's median price of existing single-family homes in California was $904,210, up 11.4% from April of 2023. In Orange County, California, the area that Brooks and I specialize in, CRMLS reported that the May median sales price for single-family homes at $1,405,000. Now, condos and townhomes, they were at $799,900. This is important. Their respective year-over-year increase was 13.8% and 9.7%. Now, experts predict a moderation in home price growth over the next 5 years. This suggests a slower and more sustainable pace of appreciation compared to recent years, rather than a significant drop in prices. Now, several factors contribute to this outlook. Mortgage rates. Higher mortgage rates impact affordability, qualifying buyers for smaller loans and potentially cooling the housing market, especially in already expensive regions. U.S. housing market. CoreLogic predicts the U.S. home prices will increase by 3.1% year over year from February 2024 to February 2025, indicating a potential slowdown, but not a major price drop. Affordability will continue to present challenges. There are several proposals currently being considered to provide assistance to first-time home buyers. Regional variations. The housing market is complex and varies regionally. Markets with limited inventory and high demand, like trendy California coastal towns or booming tech hubs, may still see price appreciation. Conversely, areas with an oversupply of homes, particularly those facing economic stagnation, might see prices flatten or decrease. Overall, while a moderation in price growth is likely, regional factors such as local economic conditions and inventory levels will continue to play a significant role in shaping price trends. The era of ultra-low mortgage rates has ended. In March of 2022, the Federal Reserve increased the federal funds rate and would continue to do so for a total of 11 times in future meetings through 2023 to combat rising inflation, pushing mortgage rates to an 8% high in October of 2023, the highest in nearly 3 decades. In the first 2 quarters of 2024, rates have yo-yoed from the mid-6s to 7% range due to mixed signals regarding the economic data related to inflation. Now, May's inflation data marked progress for the Fed. The core PCE price index, which excludes food and energy components, rose less than 0.1% in May and was also up 2.6% year over year. It was the smallest increase since March of 2021. May's CPI numbers were also well received as they came in both below estimates and the previous month's reporting. The road to containing inflation can be a bumpy one, so the Fed's tolerance will factor in. The Fed has been clear that their decision to cut the Fed funds rate is data dependent, so they will be looking for a more sustained downshift in inflation. We'll be monitoring future economic reports to see if the Fed rate cut comes at their September meeting. Expert opinions suggest a gradual downtrend in mortgage rates over the next 2 years. Several institutional projections suggest that rates may stabilize near the mid-6 range by the end of 2024, with 1 or possibly 2 rate cuts before year end. The June 12th Fed dot plot chart, which is published quarterly would continue to suggest lower rates in the future based on the available data. The Fed dot plot chart shows you where each FOMC member thinks interest rates will be by the end of the current year for 2 or 3 consecutive years. Beyond that, forecasts become less certain and depend on broader economic conditions. A robust economy with persistent inflation might require continued rate increases, while a sluggish economy could lead to lower rates. Doom and gloomers were quick to report single-family home loans held by Freddie Mac and Fannie Mae were seriously delinquent for April 2024. But what does that really mean? Freddie Mac reported 0.051%, while Fannie Mae reported 0.048%. Not surprisingly, they neglected to report that year over year, they were down from May 2023, respectively, 0.058 and 0.056. These are below pre-pandemic lows for both, and the lowest level since 2002 for Fannie Mae. We all must understand that foreclosure activity will always be part of the market, but to what degree will determine the level of concern. We unpack the data examining the full context, like the following, to provide more clarity. For instance, delinquency rates by loan vintage for Fannie Mae. Now, 2004 or earlier, this is 1% of the portfolio. Delinquencies are 1.42%. That's down from 1.47%. 2005 to 2008, again, only 1% of the portfolio, with delinquencies of 2.06%, down from 2.13%. 2009 to 2003, now this is 98% of the portfolio, but only 0.42% are delinquent, down from 0.43%. In February 2010, Freddie Mac peaked at 4.20% and Fannie Mae peaked at 5.59%. Obviously, a much different picture than social media posts would suggest when they fail to provide the full context. To better advise our clients, we dive deeper into the data than most because of the dynamic nature of the housing market and the need for continuous observation, especially as economic conditions evolve. Did you know? U.S. home prices are now 47% higher than they were in early 2020, which increased homeowner equity to an all-time high. In addition, many homeowners took advantage of historically ultra-low mortgage rates that lowered their payments and are now substantially less than what their homes would rent for. This provided another level of protection against foreclosure. It's also worth noting that the median sales price is now 5 times the median household income, which has created challenges for those pursuing the American dream of home ownership. With memories of the Great Recession of 2007 to 2009, many worry about a similar scenario. However, experts largely agree that a full-blown crash is unlikely due to several key reasons. Strong underlying demand. Unlike the lead up to the Great Recession in 2007, the current market is supported by a strong demand. The Mortgage Bankers Association reports a healthy level of first-time homebuyer applications, with millennials entering their prime home buying years. Low inventory and a growing population continue to support housing demand. It's worth noting that after the Great Recession, we went through a 15-year period where not enough housing was built to accommodate the population growth. Scarcity of a product in demand will inoculate it from demand pressures that would cause prices to collapse. Now, strict lending standards. Stricter lending standards were ushered in by the Dodd-Frank Act of 2010 to avoid another crisis like the Great Recession. This ensured borrowers would have a solid financial footing when qualifying for mortgages, thereby reducing the risk of widespread defaults, which was a major factor in the previous crash. Limited inventory. Persistent low inventory levels act as a buffer against dramatic price decline. While price growth may slow, a shortage of homes prevents a glut of properties from hitting the market. Potential government intervention. In the event of a significant downturn, government intervention could help stabilize the market. Programs like mortgage loan modifications and assistance for struggling homeowners played a key role during the Great Recession. While a major economic downturn or financial crisis could trigger a more severe correction, a housing market crash like the Great Recession appears unlikely based on current trends and data. Despite strong demand, the market continues to struggle with a shortage of available homes. Realtor.com data as of April 2024 shows historically low national inventory levels contributing to price appreciation. Forecasts on future housing supply are mixed. Some experts anticipate a gradual increase in new construction as builders respond to persistent demand. Low interest rates for construction loans and growing population may incentivize developers to add more units. Additionally, a slowdown in price growth could encourage more existing homeowners to list their properties, boosting inventory. Keep in mind, those sellers will now enter the pool of buyers. However, rising building material costs, labor shortages, and regulatory hurdles could constrain new construction. The future trajectory of housing supply will depend on factors like government policies to streamline developments, incentives for developers, and economic conditions. The next 5 years in the U.S. real estate market will likely involve a balancing act between various factors. Mortgage rates. A gradual decrease in mortgage rates is anticipated into 2026, followed by a potential stabilization depending upon the broader economic climate. Home prices. A moderation in price growth is expected, with a slower pace of appreciation compared to recent years. Regional variations will persist, with high demand areas potentially seeing some price increases, while others may experience stagnant prices. Market activity. The housing market over this period is expected to cool from its recent frenetic activity. However, strong underlying demand and limited inventory suggest that a significant slowdown in sales activity is unlikely. The market may shift towards a more balanced environment where neither buyer nor seller have a pronounced advantage. Overall, while the housing market may face challenges, it appears to be poised to maintain stability over the next 5 years, avoiding the dramatic swings that we've seen in previous decades. And there it is, the 5-year real estate forecast and some key insights. Monitoring these statistics and changes is essential for making well-informed decisions in this dynamic market environment. If you find this video useful, please remember to like, share, and subscribe for more updates. And remember, feel free to reach out to us with any questions you may have.